Hi, welcome back to the continuing lecture in investments. This is Dr. Jeff Hong, and today we're moving on to the new topic, risk and return. And you might think this is really not really a new topic, because you have already encountered this topic in Finance 100. Actually, risk and return especially, both of them, risk and return, are both, perennial topics in finance, because the main reason you are studying finance is because of the return on investment, the rate of return, the required return, the expected return. And basically, that's the main reason, right? You're in finance. Of course, the goal of, in microeconomics, think about it. What is the objective function? What is the goal in microeconomics? The goal of the firm is to what? To maximize profit, right? And to tweak it a little to finance, to align it with finance. Then it can be rephrased as to maximize the shareholder value, the shareholder wealth or shareholder value. But it's all in the same vein. Whether you call it, to maximize profit or to maximize the return, a shareholder value is basically, the stock value, right? Equity value. And the equity value grows from, return, right? Return is just the percentage, the profit expressed in percentage, right? Return on equity, which is basically profit, or EAT divided by equity, right? So we know what is the goal, but then it's not only the return that we must focus on, because you can maximize return, but at what cost? You can also in microeconomics, you can maximize profit. There are two ways you can maximize profit if you think about it. One is to maximize revenue, leaving the cost constant, right? The cost is held constant, and if the revenue is maximized, then revenue minus cost is profit, so profit is maximized. Or the other way around, revenue is held constant, but you minimize cost, right? Then still profit is maximized. But that's the second strategy is used when revenue is hardly growing. Now let's think about the that case where revenue isn't. There are many situations, circumstances under which the revenue is plateauing or revenue is hardly growing. Why? Because first of all, the market isn't growing anymore, right? The market has reached a saturation point, and then, in other words, the population isn't growing, right? If the population isn't growing, the economy isn't growing, or the productivity isn't growing, right? The productivity is not growing, mainly, because the resources or capital are limited, and there is no growth in capital or resources, or even labor, right? Productivity isn't growing, then the economy isn't growing, then the market isn't growing, because basically market means the demand, right? Demand by the consumers, or demand by the whoever is on the consumption side. Now, so just the same, in finance, what is the cost then? The cost is risk. Risk is the cost, isn't it right? Risk is the cost. So we want to maximize. There are two ways you can maximize, return. Of course, you can minimize risk. Holding the return constant, you can minimize risk, or you can hold the risk constant and maximize return. Okay, so or you can do, if possible, you can do both, but it's not realistic that you can actually do both. Now, as for the returns, the basic concept is the holding period return. It's not really any unfamiliar concept. I'm basically rewriting holding period return more familiar, or more in the way we already learned. Basically the price, sale price is basically we can rewrite it as price at time t, and the price at at the time when you bought it, right? PB, buy price, is we can call it P sub t minus n. T time t being now, and t minus n is n periods before. If PT is price this year, PT minus n is the price n years ago, which is when you bought it. And then cash flow, sum of all the cash flow during this period, right? And then you will need to divide it by PT minus n as well. But again, there are we can also express it as PT plus n minus PT, but then again, PT plus n, if PT is now, right, PT plus n is the future price, and you don't know what PT plus n will be. We will have to use expectations operator, so it will have to be expected PT. So without bothering with expectations operator, it would be easier, right, to simply use past data. And of course, we also we know this also as capital gains. PT minus n is called capital gains, right? And the cash flow during this time holding period is called income, and we can also express the initial price as price at time zero, right? Price at time zero. If I use a subscript 0 as price at time 0, or 0 means also origin, time at the time at the origin, right? Or the origin um, at the beginning, right? Time at the beginning. So I can rewrite it as P sub n minus P0. Now, of course, P0 being time 0, Pn represents price n periods later, right? Well, there can be another interpretation to that. P0 is old price, Pn means new price. But, either way, we already have the concept behind it. We already understand very fully, because, this is, Finance 100 contents. And, but the holding period return has a small limitation. What is that limitation? Now, think about it. Holding period varies from one investor to another. For some investor, holding period can be 30 years, like, treasury bond, 30-year treasury bond, or it can be, 1 year, or 6 months, or 3 quarters, or it could be 2 years. It could be, even a couple of days, right? So in other words, for a day trader, the holding period is, not even a day, not even during the trading. During the trading, right? During a day's trading, day trader, more specifically, intraday trader can make so many transactions. For such an intraday trader, the holding period can be even a few hours, or even 15 minutes, right? So then the limitations is that there can be no comparison between different holding periods. I mean, you cannot compare holding period return of 30-year, the assets that you've been holding 30 years with, return from 30-minute holding period, right? So then what is the solution? Of course, we know we need to annualize. We need to annualize that holding period return. And in annualizing means basically, taking the annual average. But we already know we cannot take simple average. There are 3 types of averages. One is, a simple average or arithmetic average, and geometric average, and weighted average. Now, of course, geometric average is a kind of weighted average as well, because it is, time weighted, right? In other words, what is discounting? What is compounding? Why are they, compounded? Why is it 1 plus r raised to n? It's basically time weighting, right? Now, and we all understand that arithmetic average or simple average is not adequate in, a time series. In other words, in the context where a variable is growing over time, right? Because of the compounding effect, and simple average cannot capture the compounding effect. So that is why it is, totally, inadequate. Sometimes, we use it. You've seen, the examples before. I mean, if in a random variable, right? For example, the stock prices, day to day, or even sometimes month to month stock prices are, well, in the long term, there's a compounding going on because, this year's price or this year's return, right? And price and return are, of course, related, because this month's price is the result of the growth from the previous month, and which is also the result of growth from the previous month, and so on. But up to a monthly return, it is generally considered like a random occurrence. Sometimes and especially if you look at daily prices, there's so much randomness, or even you've seen an example before, just to as an approximation, and as a for smoothing out, right? For less than 5-year time horizon, you can use simple average, but that is again an approximation, right? It's an approximation simply. But for anything that changes or grows over time, simple average is not an adequate measure of average, right? Now, dollar weighted average is basically internal rate of return, and we talked about internal rate of return before. It is the unique return, unique discount rate that equates the right-hand side of the equation equal to the left-hand side of the equation. Of course, the left-hand side is the present value of all the future cash flows, right? And there is only, so the left-hand side is, the current market price, right? And the current market, if the market is, rational, in the long run, of course, it is rational. A current market price should exactly reflect the present value of all the discounted future cash flows, right? Now, so let's take a look at this, a portfolio example, right? Well, this is an example to explain, how to explain geometric average, right? Now, for example, a portfolio manager is, managing. He starts out the first quarter with, $1 million under his, in his portfolio under his management, right? So that is P0, right? And then this asset grew by 10%. So at the end of the quarter, he has 1.1 million, right? So the pure growth of the asset is 10% growth rate, or you can call that return before. And then there is before net cash flow. What is a net cash inflow? This is additional capital, additional investment, right? Additional capital put into this fund, right, during the first quarter. So obviously this net cash flow is not the direct result of the portfolio's performance. But it could. It's not a direct result because the portfolio managers active management, right? Security analysis, and according to his asset allocation, according to his security analysis, and that is the performance of this portfolio manager. I mean, it's the pure fruit of his, and then it grew 10%, and the additional inflow of capital. This is not a direct result of the portfolio managers performance, but it could be indirectly related to it because if the investors heard positive news, good evaluation about the performance of this portfolio manager, that is the main reason. That could be the reason why they decided to put money into this fund. So with the net cash inflow, at the end of the first quarter, it grows to 1.2 million. Okay, so 1.2 is basically P1 plus a cash flow, right? And of course, from 1 to 1.1, right? That 0.1 million is called capital gains. Okay. Now then, in the second quarter, right? Of course, the end of the first quarter balance, right? End of the quarter portfolio balance is basically what you have at the beginning of the second quarter, right? So at the beginning of the second quarter you have 1.2 million, right? And then it grows to 1.5 million by the end of the second quarter, right? So the pure return or the growth rate is 25%. And then during the second quarter, there is a cash inflow, net cash inflow of 0.5. So by the end of the second quarter, there is total of $2 million. Okay, that's at this end of the second quarter. And so the portfolio balance at the end of the second quarter, the portfolio balance is the same thing that carries over, right, to the third quarter, and it becomes the beginning balance at the beginning of the third quarter. So doesn't this remind you of something? I mean, if you have taken corporate finance with me, or if not corporate finance, FNB 230, right? Otherwise, even business math, BUS 210, then you would remember, in inventory, right? I mean, in income statement, right? You have, inventory, beginning inventory of a, let's say, beginning inventory of the current quarter is basically the ending inventory of the previous quarter. Of course, then the ending inventory is carried over the previous quarter's ending inventory is carried over to the current quarter's, the beginning of the current quarter, so it becomes the beginning inventory of the current quarter. So it's the same thing, same concept. In other words, midnight today, right? Midnight Thursday is the same thing as 0 hour, right? 0 hour Friday, right? December, end of this year is the beginning of the new year. The same concept. So we have at the beginning of the third quarter, we had 2 million, but during this third quarter something happened. Economic downturn, bear market, or the correction in the market, or whatever. 20% loss is not a simple correction. 20% loss is like a bear market. So the fund lost 0.4 million, which is like 20% loss, and the investors got disappointed, or investors panicked, so they pulled out their money, right? And they pulled out almost 800,000, or 0.8 million. So the fund balance at the end of the third quarter was 0.8 million. So this portfolio manager begins the fourth quarter with 0.8 million, but during this quarter the fund grew by 20%. So by the end of the quarter, it grew to 0.96, and then there is a net cash inflow of 0.6 million. So it ended up with 1.56 million by the end of the fourth quarter. So now suppose think about it. The growth rate in the first quarter was or the return in the first quarter, right, is 10%, right? And so if you began with 1 million, I haven't wrote 1 million at the beginning here, but how did I get to the 1.56 million? Starting from 1 million, right? It's thanks to the growth of 10% in the first quarter, right? And then thanks to the growth rate or return of 25%. And then, of course, although it is negative return, right? But also growth rate in the third quarter of negative 20%, and fourth quarter growth rate of 20%, right? It's basically compounding. The idea is, right? You might think, isn't compounding, like one plus r raised to fourth? Yes, think about it. If r1 is equal to r2 equal to r3, which is also again equal to r4. In other words, r1, r2, r3, r4, if all of the quarterly returns are all the same, then you will simply reduce to what? 1 plus r raised to fourth power. Isn't that right? Yeah, in other words, so then what is the in reality, no growth rates, no two growth rates are equal. Uneven. The growth rates are generally uneven. But how do you find how do you make them constant? In other words, to make all of them equal, they're not equal, but to get to the same result. In other words, whether you compound them with different returns, or whether you compound it with the same return to arrive at the same future value. The only thing that makes it possible is by taking the average of, right, those different uneven growth rates, and if you replace those R1, R2, R3, R4, if you replace it with the average growth rate, then compounding it by 1 plus average return to the fourth power will give you the same result. Right? Makes sense? Again, I've been, you may have noticed that I've been using the term return and growth rate almost, interchangeably. But look, in Finance 100, I made it very clear. Return and growth rates can be the same thing when there is only capital gains. In other words, if there is no incidental income or incidental cash flow, right? If we are dealing with only P0 to P1, P1 to P2, right? In other words, if you're dealing with only capital gains, then the growth rate of the price is the same thing as the return, right? But then these two, growth rate and return are different if there are additional cash flows, because additional cash flows, or I call it incidental cash flows, which are also called investment income, right? Such as dividends or coupon payments, right? And if that's the case, then they're not exactly the same, right? Because there's additional component in calculating return, right? So, but the growth rate is basically, the result. Growth rate is the result of pure growth in your capital, right? Original capital. So growth rate can be defined as the return when there is no incidental cash flow or incidental investment income, right? Now, so I'm using, RG for, what do you think that G stands for? Geometric average, right? It's, you might think, growth. Yeah, but as I said, there's a difference between growth rate and return. And in this example, we have additional cash flow. In other words, investors are every quarter, investors are making additional investment into this fund. So there is, a difference between, clear difference between, return and growth in this case. So G in this case stands for geometric average, right? And the geometric and to find geometric average, in this way, you would have to take the fourth radical or fourth root, and then this exponent and this exponent will cancel out. So you're left with only the left-hand side, which is 1 plus RG, and then if you subtract 1 from it, then it becomes, a geometric average. So another, we already know another, what you learned in Finance 100. Another method is, basically future value, right? I'm gonna get to that, but it's basically because it's basically the compounded result of compounding to the fourth power. So we have to to get rid of that exponent, we have to cancel it out by raising it to the taking the fourth radical, or fourth root, and then subtracting 1 from that. But again, we also from Finance 100, the another way of finding it is FV, future value, over PV, present value, right, raised to 1 over n, right, minus 1. And that formula was derived from the very basic compounding, single cash flow compounding model, compounding formula, right? And which would be slightly different from geometric average found this way. I mean, from the I'm using, just approximately equal to, and then if you actually, find it, in two ways, right? They will slightly differ. And that's, inevitable, because, all of the, there's a lot of, think about it, all these, growth rates that, we found were, in a way, rounded, right? They were rounded numbers, right?